So we heard the hawkish talk, and our question of the day that I want to bring to you is, does central bank talk still pack a punch?
I think it certainly does in the bond market, maybe not quite as much in the equity market.
So talk to me about that, because yes, we're seeing a really chunky move. You got 16 basis points higher in the 2-year. Why do you think we're seeing divergent interpretations within different markets?
So certainly in the bond market, I think there's a realization that the Fed really is going to keep at this. They've been talking about this really since a year ago, that the message became really focused. Our primary goal is fighting inflation. We're going to do that. Remember the Jackson Hole speech last August, when Jay Powell ripped up the normal script and said the same thing 8 times, that we're going after inflation. Markets still took a long time to kind of get their arms around that. But I think that, but I think the bond markets are now starting to see these guys are serious. The equity markets are thinking, well, maybe we can still have this immaculate disinflation. That is, that we can have the inflation rate come down, and it has come down quite significantly from the peaks of last year, although still quite a bit above the Fed's 2% goal. That we could have that come down without significant increase in the unemployment rate. I mean, so far we're still seeing very robust job market. I mean, the most recent numbers this morning show that claims are still low. We're near record levels of low unemployment. But I think it's going to be very hard to make it from where we are of 3.9 to 4.7% inflation, depending on what your favorite measure is, to get down to 2. And I think that's only going to come with a significant rise in the unemployment rate.
Yeah, I mean, who am I, Randy, to disagree with the meat-eating bond traders and side on with the equity traders in la land? But, I mean, if you just look at the data today, we had growth revised up, inflation revised down, the claims rug was pulled. Inflation, as you said, Randy, it is coming down without employment seriously spiking. I mean, does that not suggest that trajectory on its own, that the immaculate disinflation, it could potentially happen?
It's certainly possible. We've never had it before. And so that's why I think many people like myself are skeptical of it. But I've been through enough, having been at the Fed during the global financial crisis. I never say never about anything. So it is certainly possible. But what I worry is that the Fed's going to have to bring things to the breaking point. I think Jay made it clear that they've got at least 1 or 2 more increases up their sleeve for the rest of the year. That means that their resting point will probably be a little bit closer to 6 than it will be to 5. As inflation starts to come down, that means that the inflation-adjusted interest rate, the so-called real interest rate, will be going up as inflation comes down. That means it's harder and harder for firms to beat that hurdle rate, and investment going down. Maybe you see some adjustment of asset prices, and so you could get into a more difficult situation towards the end of the year or beginning of next year.
Did you just say 6%?
I did. Remember, we're in the low, we're 5 and 5 1/4. If they do 2 more rises, we'll be at 5.5 to 5 3/4, which will get us closer to 6 than it will be to 5.
Well, that would be something. I also wondered, to that point, where might we see the most action? We're clearly seeing a re-rating in the bond market. To some extent, it feels like the equity market is moving on, say, earnings, for example. I understand that Micron's down, but we have some solid numbers from like H&M and Renault, like kind of calling the trough in some of the worrying sectors. What about FX? I just wonder how strong the dollar gets until it starts to bite and the Fed has to worry about it.
Yeah, the Fed doesn't primarily focus on the dollar. They want to make sure that there's no disorderly movements either up or down in the dollar, but that can have an impact. And obviously, a lot of it is what people are assessing the Fed is going to do relative to the ECB or other banks around the world. I think there's a lot of worry that at some point, Bank of Japan is going to have to pull back, and that could cause a little bit of tumult in those Japanese markets that have been relying for decades on the central bank to always buy equities and buy securities. So I think there could be some tumult coming, both in the forex markets, but also I think I keep my eye on Japan.
Yeah.
I was going to say the biggest surprise out of yesterday's panel was Japan, not in what they said about policy, Randy, but was the absolute jokester Kazuo Ueda having the audience in absolute uproar multiple times. That's definitely my favorite point. But Randy, to kind of a different point, Dario Perkins of TS Lombard has this really great note out today talking about R-star, the value of equilibrium that we use to judge whether policy is restrictive or not. Basically saying, look, the models for this are often wrong. Are we thinking things wrong here when we're trying to judge whether policy is restrictive or not? Is R-star actually a measure we should be looking to?
Yeah, the challenge with the so-called R-star, the equilibrium rate, is that it used to be seen as a constant of around the real rate being 2% and then 2% inflation, so 2 plus 2 gets you to 4. Now it's seen as that underlying real rate is bouncing around a lot with demographics and supply constraints, other sorts of things coming into to affect it. So it's much less of a guidepost than it once was. But this gets back to what I had said before, that as the Fed, I think, holds in the, let's say, roughly 5.5% area, inflation will start to come down a bit more, but that means that the real rate, the inflation-adjusted rate, is going to be higher, and so the real borrowing costs, the real burden, is going to be going up. And I think that's going to make it more difficult to sustain the kind of growth that we've been seeing over time.
Yeah, so sort of that delayed monetary policy effect, which has been quite delayed.
Yes.
Randy, why? Why has monetary policy transmission been so delayed? And part of me fixes it on the housing market, because if you have so much wealth that's been unlocked over the last couple of years because rates are so low, that doesn't just go away. That's going to stay.
So I think one of the things that's happened is that so many people, at least in the U.S., finance into long-term fixed-rate mortgages at really low levels back over the last couple of years that no one wants to move. This is one of the reasons why we see such a tight housing market, that there's so little inventory out there, and so that normally one of the key transmission mechanisms is Fed changes rates. That it affects the 10-year rate. That affects the borrowing costs for most households. Well, if everybody's on a short-term or a low long-term fixed rate, it has a much less of an effect, and it's going to take more time for that to have an effect. Also, something that happened, which I think is helping to support the economy, is that effectively we had a stimulus that came from that. People, by refinancing to much lower fixed rate mortgages, they've got a few $100s or a few $1,000s a month that they didn't have before, because they've got those
right.
low rates. And so effectively, that was like a stimulus on top of people not responding, because they're not having to respond until they have to sell their homes. And hopefully, we won't see the unemployment rate go up too much. But if we do see the unemployment rate go up much, then you get to this 1-2 punch in the housing market, a lot more supply coming on, and then new people coming in having to pay much higher interest rates. That'll probably put a lot of downward pressure on prices.